This is a great question, Lee. I'm glad you asked this. And let me just tell everybody, I'm going to give everybody a few seconds here, longer than that, a lesson on how markets work in a real basic, simple way. Let me just tell you how it's supposed to work, not how it's worked. But here's what's supposed to happen. So the economy gets good and is good. When the economy is good, people are being hired and they have opportunities to work and they get pay raises because they have so many opportunities. Employers keeping the employees they have, they get pay raises. They get more discretionary income. As the economy gets better and there's more discretionary income, you and I buy stuff. We buy stuff. When we buy stuff, companies are manufacturing more stuff, creating a better environment for employees and companies. And as we buy more of their stuff, their bottom lines get better. Their earnings get better. Their profit margins get better. And when their profit numbers get better and their bottom lines get better because people are buying stuff and the economy is thriving, what happens is people buy their stock. When that happens, their stock first goes up because their bottom line is getting better, and people see their stock going up and they say, hey, something's going on. Their stock's going up. I want to get in on that. And then they start buying more of their stock, which drives the stock up even higher. And the market, not the economy, the market is getting better because of the underlying fundamentals of the economy. See, the economy, not the Federal Reserve, not the federal government, but the economy is supposed to be driving stocks up. We didn't have that. We have that now. The underlying fundamentals, there's actually organic growth in the economy, something we haven't had in 10 years. We have actually organic growth. What we had for the last 8 years, but I'll say last 10 years, but definitely more likely the last 7 years, was we had this enormous amount of quantitative easing. We had the Federal Reserve intervening in a dramatic way, dramatically increasing the amount of money that was available. Companies doing nothing illegal, nothing wrong with this. It's not anything that wrong. I mean, companies were sitting on some cash, unwilling to invest it in the economy because they weren't getting any organic growth. But their earnings were going up because of a number of reasons. One is money was very cheap. They were using that money to buy back their stock. So stock was getting bought. Stocks were going up in price. The bottom number and paying off their debt was increasing the value of their stock from an earnings standpoint. And their earnings were going up, so they were satisfying their stockholders. But if anybody out there has listened to me for the last 10 years, but I'll just say the last 3 or 4 years, you will remember me saying, who cares about earnings? We've got to stop looking at that. What we've got to look at is sales. So their sales numbers were going down. Same store sales, they're manufacturing products. They were manufacturing less products. Well, wait a minute, how's their earnings going up? Their earnings is going up because they're using cheap money that the federal government and the Federal Reserve was infusing into the markets to prop up their earnings. So the stock market's going up based on false positives to you and I, not to institutional investors. They knew what the deal was.